Good evening and welcome to this evening's Strategy of the Week titled Options, Making Money in Bear Markets. My name's Kevin Crowe. I'm the Manager of Retirement Services and I'll be your host this evening. This Wednesday, VectorVest issued a confirm down. Client reactions when we receive a confirm down generally will range from fear to frustration. The fear arises from concerns that either they'll lose money or they'll no longer be able to make money. However, what if we approach a confirm down as an opportunity to make money while keeping our strategy simple and disciplined and systematic? This evening, we're going to examine buying puts as an opportunity to continue to make money in a down market. Options are often misunderstood because of terminology and definitions. So let's take a brief look at two important factors that investors must conceptually understand and control in order to make money with options. Let's start with delta. Delta is the amount an option's price is going to change or expected to move based upon a $1 change in the underlying stock. So if we have a delta of 1 and the underlying stock changes from 50 to 51, then the underlying price of the option will change by $1. Theta, on the other hand, is the amount of price change of calls and puts in terms of their decrease for a one-day change in time to expiration. To offset the ravages of time decay, the option buyer must learn to have an appropriate balance between time, or theta, and price movement, or delta. And as an example, if time to expiration is too short and the underlying is not moving, then the time decay will absolutely overwhelm the option price movement and the client or the investor will not make money. To be effective at buying calls and buying puts, it's generally recommended that when we buy calls that we have a delta that's equal to or greater than 0.80. And if we're buying puts, that we have a delta that's equal to or greater than minus 0.80. And in terms of time, at least 60 days or more to expiration is warranted, given what we discussed earlier about the ravages of time decay on price. During a confirm down, there are a number of things we can do as it relates to making money. First, we could short stock. Short stock is an effective way to make money. However, it has a lot of entanglements in terms of regulations. Everything from borrowing the stock from your broker-dealer to paying interest on it. Buying contra ETFs has made things somewhat more simple. However, one must choose between equity ETFs or index ETFs. We can hunker down and go to cash or buy puts. If one accepts that we have been in either a bullish or a bearish secular market over the past 30 years, then in my opinion, acquiring the skills to effectively buy puts makes a lot of sense. So tonight, let's use one of our unisearch searches or strategies called IG plungers. Now, some of the parameters that I like in the IG plungers is first, it has to have volume greater than 100,000. The stock price has got to be equal to or greater than $20. The industry RT needs to be lower or has been lower over the past 10 days. And the VectorVest recommendation is a sell. Let's now go to our home page and we're going to begin this journey by looking for the Unisearch tab. We're going to click on the Unisearch tab and we're going to move over to our searches and scroll down till we get to Strategy Short. When we get to Strategy Short, we'll scroll down some more until we get to IG plungers. Please note that the date is 6/7 of 2013, today's date, but what I want to do is conduct a backtest to validate how buying puts can be a viable strategy. So I'm going to change our date from 6/7 of 2003 back to the last major confirmed down that we had, which was in October 22nd of 2012. I'm now going to run search, and we come up with several stocks. And very simply, I'm just going to choose the 5 top stocks by highlighting the first one, holding down my shift button, and clicking on the 5th one. I'll come up to our quick test tab. I'm going to change our top 10 to our top 5. Click on the highlighted area. And you'll notice that we had some downturns in stocks denoted by the negative red areas. But our date is from 10/22 to 6/7. So I've got to change our end date, and I'm going to change our end date to the beginning of the confirmed up in December, specifically December the 18th. Click on the 18th, click OK. Now I'll come back up here and run test again. The same stocks that were down before are down now. However, we've got 3 that were down by 23, 24, and 17%, or almost 18, and 2 that were up by 12. These are the stocks that we're going to test as to the viability of buying puts by using Option Analyzer. So let's come up here to our first stock, BTH. And I'm going to right-click on BTH. I'm going to find Analyze Options, click on that, come over to Bearish, click on Bearish, and come over to Long Put. Now, as you may recall, our trade date was 10/22 of 12, the confirm down. This is a profit profile of a put, but our date under current data is the November option expiration date. So using this double left arrow, I'm going to bring us back to our trade date. Coming down to our data line, I'm going to scroll over until I find the delta, and you'll notice that the delta is negative or minus 0.53. Well, earlier I mentioned 0.80, so how do we change that? Well, we're going to click on our Edit tab, and we have our November date, and I mentioned that 60 days plus is usually desirable. So I'm going to change our expiration to the December expiration month, and given that the strike price is almost equal to the stock price, I'm going to put us further in the money, and I'm going to go to the 35 and see how that helps. Again, coming down to the data line, I'll scroll to the right, and you'll notice we now have a delta of 0.83. Well, I like that. So what's next? Well, I mentioned a moment ago that the confirmed up would be the time in which we would measure the potential of making money with puts. So I want to measure 2 things. One, to see what would happen if we held until expiration BTH using the December 35 puts. So I'll change our date on our calendar to the 18th, and you'll notice, wow, we would have made $5,100 on a debit of $11,600, almost 50%. Well, that's fine and dandy, but perhaps for those who are a little bit more conservative, and remember, we don't know how this is going to turn out when we put on the trade, so one way of looking backwards to teach us the performance of price and profit, I'll go to Trade Simulation. Now, Trade Simulation, and I'm going to come back to our beginning date of 10/22, which is our trade date. What the simulation shows us is that as prices dropped, profit began to rise. Well, I want to do another thing, and that is, what if beginning on the 22nd, I said, you know, what if I took this one day at a time? Could I find a place where I'd be happy taking a profit, especially if I had a predetermined profit and loss parameters? Well, by clicking one day at a time, you'll notice one day into the trade, I'm down $150, and we're going to assume a 10% gain or a 10% loss. Next day into the trade, I am slightly positive. 3 days into the trade, I'm up $450, getting really interesting. 4 days into the trade, I'm pretty much right at that 10% gain. Now, some of you may wish to continue this journey and move your stops up as your prices and profit moves up. I, being a little bit more conservative, when I hit my 10% mark, I close my position and go looking for the next opportunity. Is there a right or wrong answer? No. It all depends on your risk tolerance, the amount of money you're committing to this type of option trading. But in any case, using some methodology of profit stop or stop losses is advisable. Let's clear this, and let's go back to our stock picks. Let's go to ESI. Again, we'll right-click, go to Analyze Options, left-click, go to Bearish, go to Long Put. We can confirm that we have ESI in our symbol box. Our trade date is 10/22 of 12. But again, down below here, this has taken us to the expiration date of January 19th of 2003. You can see the January expiration. So I'll click on this double left arrow to take us back to the trade date. Like I did before, I want to scroll to the right, and I see that my delta is negative 0.49. Well, this is not acceptable for me. So what I'm going to do is, again, hit the Edit button and find that balance between expiration and strike price. Well, again, our trade date's the 22nd. January is the expiration in this case, so I feel comfortable I've got enough time. If I come over to the strike price and scroll down, and let's say I go to the January 45, click OK. Again, I'll scroll to the right, and I've got a nice delta of 0.90. Well, again, let's see what happens at expiration. So if I come to the calendar, move forward to the 18th, we have about a 30% return, a very, very healthy return. However, again, as before, I want to see how this trade would have performed and the decisions I might have made by going one day at a time. So on the 10/22, I'm moving forward day one, I'm up $70. Now remember, I'm looking for a 10% profit. Day two, I'm up $920. Day three, $36.50. Have I hit my 10%? Yes. Am I gone? Yes. So again, by moving forward one day at a time and adjusting your stops and making your decisions, you're able to take money off the table. And you have to decide, as I stated before, are you looking for the home run ball, or would you rather make singles every inning? So let's briefly review what we've done. We chose a strategy that is a short strategy, a bearish strategy. When we chose that strategy, we decided to use puts. And by entering trades on confirmed downs and potentially taking our profits by a day-to-day evaluation, or keep moving our stops as the underlying security went down in price and profits went up, we are in control of our trade. By way of summary, let's review some things that I believe you need to remember. First, market timing is always the key. If you solely use confirmed downs and confirmed ups, you have an opportunity to make very good profits over time. Next, if we're buying puts, we are looking for a delta of at least minus 0.8 or more. We should always go into a trade with predetermined profit and loss values or stops. And in the examples I used, 10% stop for both profit and loss. However, if you want to let your profits run, please adjust your trades on a daily basis. We should have an appropriate balance between the option price and the delta. Fourth, use Option Analyzer. And last, you get a 2-week free trial if you do not have Option Analyzer. And at the end of that trial, we'll give you a $100 discount for your purchase of Option Analyzer. In closing, I hope this was a valuable presentation for you this evening. Don't hesitate to call. Again, my name is Kevin Crowe, Manager of Retirement Services, and have a great weekend.